Hello and welcome. My name is Burke Purcell. I am the founder and CEO of LoanBud. Today, we are going to discuss how to evaluate a deal for SBA financing. First, a bit of history about LoanBud. LoanBud started as a division of a public bank and a top 10 national SBA lender. At the end of 2022, we parted ways with that bank to become an independent marketplace. So we did that so that we can open up our credit box and better serve our customers and our partners. And today we work with over 50 SBA lenders on our platform. We are an SBA financing marketplace. Our mission is to empower entrepreneurs to gain access to the SBA loan program. And we do so as the only marketplace in the United States dedicated to SBA lending. So background on myself, as I mentioned, I'm the founder and CEO. I have over 2 decades of lending experience, have grown and scaled multiple teams, and I really am an advocate for the self-employed community. I've been serving the lending needs of the self-employed for the last 10 plus years. And I noticed a lot of inefficiencies with the SBA program when I was inside of a bank. And that is part of what prompted me to start and found LoanBud. So why does deal evaluation matter? Well, first, we need to understand if a deal is going to be financeable. Not all businesses can be bought and sold using SBA financing. The most common reason why it doesn't work is because the SBA is a cash flow lender. What that means is that the business that is being sold needs to have enough profit in it after all of the add backs to be able to support the new SBA loan. And ultimately, brokers are going to translate value between sellers, buyers, and lenders. And there's 3 concepts that we are going to review and discuss today. That is seller discretionary earnings, SDE, add backs, and debt service coverage ratio, DSCR. So there's what I call the deal triangle, which is our seller discretionary earnings, the add backs, and the debt service coverage ratio. All of those things really make up SBA eligibility. And these things are really critical in SBA lending. It's going to reveal a business's true cash flow, what its financeable value is, and prove ultimately whether or not the buyer can afford the new debt. So add backs are what we look at to really normalize the financials. We'll talk about what are standard and traditional add backs versus other types of add backs that require further documentation. The SDE, the seller discretionary earnings, is really a true indication of the cash flow that the owner has access to. And the debt service coverage ratio is the ability to cover the loan payments with a bit of a cushion built in. Let's talk about SDE. So it's defined as the total financial benefit to a single owner operator. If there are multiple operators, then that benefit could apply to all operators. But we're looking at a number of things here. The first is, what is the net profit of the business? When you look at a tax return, usually the bottom line on page 1 of a tax return is the net operating income, otherwise known as the net profit. We're then going to add certain items back by default. That is going to be the owner's salary, the depreciation, amortization, and interest. You won't always find depreciation, amortization, and interest on the tax returns of a business that's being sold, nor will you always find an owner's salary. Sometimes you have a business being sold that does not have owner's compensation included, but when they're present, those are automatic add backs to what we call EBITDA. And on top of that, we're going to have the seller add backs that can either be one-time add backs or simply the seller's personal expenses that are inside of the business that's being sold. So let's look at a sample calculation of SDE. We can have net profit of $100,000, owner's salary of $60,000, some discretionary add backs of $20,000 and depreciation of $10,000. That gives us the free cash flow available of $190,000. Important to note here, the new buyer of the business, the owner of the business, is going to need to take a salary. And so we usually, when we look at evaluating a business that is being sold and we're just doing a pre-qualification up front, we're going to have to put a placeholder in for the new buyer's salary because we don't know yet what they're requiring to take as a salary. For example, you may have a buyer that really doesn't have a lot of debt, or maybe they have outside personal income that they're going to keep. That individual might not need to take much of a salary at all. The minimum required salary of a buyer is going to be $25,000 by most SBA lenders' standards. On the other hand, we might have a buyer that has $10,000 in a month in a mortgage, and then another $3,000 on auto and student loans and credit cards. And next thing you know, we have a buyer that needs to take a really substantial salary. Well, that's going to, kind of impact whether or not that individual could be qualified for that business. Talking about add backs, there are going to be adjustments that are either non-essential or really discretionary expenses. So I would classify these into what I call personal expenses, for lack of a better term. So an owner's automobile, their personal travel, their cell phone, family members on payroll, these are all going to be discretionary expenses. We also then have one-time fees, like there was a lawsuit and there was $100,000 in legal fees during that calendar year. As long as it's not recurring and we don't expect it to come back, we can generally get comfortable with adding that back. And then depreciation is a standard add back. So we're looking at all of these add backs, and we'll talk a little bit about how we're able to actually use these add backs. Debt service coverage ratio is defined as a business's ability to cover the loan payments. And what we do is we look at the available cash flow after all of the add backs divided by the annual debt service, and that equals our debt service coverage ratio. To put that into a better term, if the loan payment is $1 per month, we're going to need the business to have at least $1.25 of free cash flow. So our debt service coverage ratio usually needs to be at least at a 1.25. So again, if you've got $100,000 a year in SBA loan payments, the business is going to need to have free cash flow of at least $125,000. And that is after the owner takes a salary to be able to pay their personal expenses. So bringing it all together, brokers should quickly translate financials into seller discretionary earnings, look at the add backs, document them, and understand what kind of debt service coverage ratio is available to be able to support an SBA loan. This is going to help pre-screen SBA loan eligibility, really set expectations for the seller up front, and it's going to guide buyer feasibility, whether or not this is a business that can even be purchased using SBA financing. And then a weak debt service coverage ratio or unsupported add backs can certainly kill deals. So now we're going to review a practical example. This is a business that's being sold for $2 million. And on the left-hand side, we have a sample of all of the numbers. So the business is doing $1 million in revenue. We have all of the different numbers here. The gross profit is $600,000. We have also a number of expenses: owner salary, rent, utilities, personal, travel, one-time legal expenses, depreciation. So we have the total operating expenses as $243,000, and the net profit is $357,000. But we have here on the right side all of the add backs here that are present for this deal. So the net profit is $357,000, but we're then able to add the owner's salary of $120,000, $15,000 in personal travel, $8,000 in the one-time legal expenses, our depreciation of $15,000. So when we add all of those up, now we're at an SDE of $520,000. So with a $2 million sale price and an SBA loan amount of, say, $1.7 million, the annual debt service is going to be roughly $269,000. So our debt service coverage ratio here is a 1.92, which is great. Now, this does not yet account for the new owner's salary. So that is something we're going to need to adjust for. We would normally have a placeholder of $75,000 for the new owner's salary, but that could adjust up or down depending on the actual substantial circumstances for that buyer that's coming in. But as it looks right now, I like this business. I think we're on the right track here. Just a matter of building in a reasonable salary for the new owner and going from there. So bringing it all together for what this means for brokers, a deal that does not work on paper is maybe not going to close in reality. Most small businesses that are being bought and sold in the United States that are less than $5 million in enterprise value are probably going to need financing. Most people that are buying businesses in this space are not going to pay all cash $2 million to buy a business. It's really not realistic. So the really almost one and only option here for financing is going to be SBA. The SBA is a great option for buyers in this category because most of these businesses do not have assets. They don't have substantial collateral associated with them. So SBA is a cash flow lender. It only requires 10% down from the buyer. It's how most businesses will be financed in this space. So we need to understand, is a deal going to work for financing or is it not? Because if it doesn't work, that's really going to change your approach as a broker in terms of how you market that listing. So sellers need to understand what's realistic in terms of valuation, and ultimately what can SBA financing support, regardless of the multiple the market says is out there or what a seller believes is out there. In many instances, it's going to have to be supported in some fashion with an SBA loan. Buyers need confidence in financing, and then lenders ultimately need to document everything so it can pass underwriting. How LoanBud helps here is that we will evaluate up front the SDE and the add backs. We're going to look at the analysis. We're going to help validate financials. We'll point out what we are using, what we're not using. And if we are using anything outside of standard EBITDA, we'll let you know that we are going to need a quality of earnings report to be able to substantiate those add backs. We're also going to do DSCR pre-screening. So we're going to make sure that it meets the minimum required debt service coverage ratio, which is typically a 1.25. That's what most SBA lenders look for at a minimum. And then we're going to do a pre-qualification. So we'll pre-qualify the business up front that is being sold and ensure that it's SBA loan eligible. And that's really going to boost the interest you'll find from prospective buyers. Ultimately, that could lead to a higher sale price, a faster closing, more interested buyers, and a more efficient process in general. So that, again, is going to lead to faster closings. So we standardize everything. We make sure that we have the sell side screened and the buy side screened, and then we bring all parties together. So you can win listings by getting your listings SBA pre-qualified. You can let your sellers know that it's a free service that you offer to them, that we're going to make sure in advance of going to market that the SBA loan option is something that would be obtainable. And you're going to ultimately attract much more serious buyers if you have that finance ready, SBA ready approach. And you're going to definitely close more transactions and faster with a trusted SBA marketplace partner. That's all that I have for today. Thank you for all of your time. Feel free to reach out to us at transworld@loanbud.com. Thank you.